The S&P 500 just pulled off another record close yet again, while the Dow and Nasdaq ended the day only slightly lower, while Bitcoin was pretty much struggling. Under the surface, we've got hot wholesale inflation data that we've gotten, steady jobless claims, fresh warnings from big name investors about valuations in this market. Let's break it all down. So the S&P 500 locked in a new record close while the Dow and the Nasdaq barely slipped. This comes despite a market where a handful of tech names have been doing most of the heavy lifting we've seen this year in the market. And Howard Marks over there at Oak Tree Capital, he's co-chairman, doesn't think the Magnificent Seven are overvalued, so to say, using PE ratios, price to earnings. He finds that the average of around 33 is reasonable given their exceptional products, dominant market share, high margins, and competitive moats, strong competitive moats. Where he sees the problem is in the rest of the S&P 500 instead. The other 493 companies carry an average PE ratio or price to earnings ratio of 22, which is well above the mid-teens historical average, which he says makes the index's overall valuation possibly worrisome. Then it doesn't end right there, because DataTrek research notes that Nvidia, Meta, Microsoft, and Broadcom have provided 60% of the S&P 500's 10% gain that it's seen this year. Nvidia alone accounts for 26% of that rise. Without that, the generative AI buzz, if they haven't got that, the index would likely be up only about 3 to 4% instead of that 10% that everybody's cheering right now. While AI leaders have strong earnings and business models, this narrow leadership makes the market more seen as vulnerable. If the AI trade stumbles, the S&P 500 could lose 6 to 14% according to what they're talking about in this article, or even more if sentiment turns sharply. Then, at the same time, Americans' retirement accounts are more tied to the stock market than ever before in history. Late 30s workers equals about 88% in equities versus 82% just a decade ago. Early 60s, we see they're at 60% versus 57%. Target date fund starters, 92% equity versus 85% in 2014. And that high equity allocation has fueled gains in the bull run, but could magnify losses in the face of a downturn. Also, look at this. This was interesting. Treasury Secretary Scott Bessent said that the U.S. will no longer be buying Bitcoin for its reserve. I don't know if they ever have. Maybe fact check me on that. But currently valued between $15 and $20 billion. But it won't stop selling confiscated assets but it will stop selling confiscated assets and continue to build its reserves through seizures and means in relation to. Bitcoin dropped about 3.7% on this news because a lot of people were hoping that there's going to be this big well of a buyer, the US government, to come in and buy up Bitcoin. Then we got July's producer price index. Wholesale inflation is what this measures. It's a PPI for short. And what we've seen is that this jumped 0.9% month over month, the fastest pace in nearly 3 years. Economists expected that this would have just happened at 0.2%, but it came in higher than expected. The annual rate climbed to 3.3%. And let's break it down. So goods up 0.7% month over month. Food prices up 1.4% month over month. Within that category, we've seen eggs up 7.3%. Beef and veal up 4.6%. Electronics up 3.8%, with TVs and video related products up 3.5%. Computers and software is included within that. Core goods up 0.4%, which is the highest gain in over a year. Services up 1.1% month over month. And this was driven by trade services, mainly along the lines of retail and wholesale margins, which was up 2%. And then portfolio management fees up 5.8%. So economists say some companies are using tariffs as just an excuse to raise prices and boost margins, while others are passing through more costs to consumers. We also got jobless claims today, and they held pretty steady. So initial jobless claims fell to 224,000 from 227,000 the week before, better than the 229,000 that we were expecting to come in. Continuing claims dropped to 1.95 million. That's down from 1.97 million. The number's still pretty big though and alarming if you just look at it. The labor market remains pretty solid overall though. There's no signs of large layoff wave, although companies still aren't hiring. I sound like a broken record player every time I mention that. So markets are at a record. But leadership is narrow, valuations outside of big tech are stretched, AI enthusiasm is powering gains, but also concentrates risk within that. PPI's hot print shows inflation pressure in the pipeline, especially within the services and core goods. Jobless claims remain low, given the Fed's less urgency to cut rates aggressively. A lot of people said on the PPI that 50 basis point rate cut that a lot of people were hoping for, it's a not now. Retirement portfolios are more exposed to equities than ever before, amplifying both gains and potential losses. And we'll just keep on watching to see how all of this continues to develop. See y'all back tomorrow. I'm feeling a little bit better, but if you can't tell, man, I'm like soaking right now. So wish me well. I'm looking forward to healing up and being back to 100% so I could be here. But yeah, I hope y'all are doing better than I am, and I'll see you in the next one.